Hello everybody, Tortoise Investing, coming at you today with another video. I hope everyone has been doing well. Things are looking pretty good here in the market today, down just a little bit, but you know what? There'll be red days, there'll be green days. Can't really complain too much. Let's see how the overall market's doing. We're down about 0.5%. Yep, beating the S&P today. Sweet. Alright, keep rolling with it. Anyways, guys, if you're new, please hit that like and subscribe button. I greatly appreciate it. Helps me grow, and let's march on to 1,000 and then onward from there. And comment down below. It can be anything. Let me know what you've been buying, if you've got any feedback, or if you have any questions. I reply to every single comment. So today's video, we're going to be looking at 5 dividend growth stocks that I think are pretty good prices that I just want to let you know of. I'm going to show you the dividend growth, and some of the financial stuff through Qualtrim. Everything I use in today's video, I will have a link in the, I have the links in the description, so you can check all those out if you would like. Without further ado, the first one on the list is Johnson & Johnson. I think that this is at a pretty good price. It is one of the old reliables. This thing's been growing its dividend for 61 years. That is ridiculous. It's got a 10-year growth rate of 6.37%, so very reliably beating the overall inflation rate. And like I said, 61 years, that is just absolutely insane. It's got a pretty low payout ratio there at 41.5%. So take a look at it here through the Qualtrim. Yeah. Alrighty, so if you look at the financials, it is down a bit on the year, which I think it's at a good value right now. It's got a free cash flow yield of 4.14%. You like to see that above 2. It's got more cash than debt. That is always a great indicator. Revenue's climbing. EBITDA's going in the right direction. Free cash flow, net income, EPS. Yeah, you always want to see that. More cash than debt, it's a rare thing to see, but you love to see it. And that dividend's just a stair step all the way up. It's got a okay return on capital. Nothing to really go shout home about, but they are financially stable, and like I said, the recent drop here I think gives a good entry point for it if anyone was interested in it. I try to invest in things that have 10% or higher growth, so that's the only reason I'm not in J&J. If it wasn't for that, if I was already like retired or whatever, I would absolutely have this in my portfolio. Now, next up, United Health Group. I got into this stock right when it dropped below 500. I think that it's still a good price. I think it's a good value. It has beaten the S&P 500 very consistently for a long time. They've been paying their dividend for 13 years. Their dividend growth rate over the last 5 years is 17.36%, and over the last 10 years is 23.11%. Ridiculous. Love to see it though. That's what I go for. That's what I gun for. This is actually makes up a good chunk of my portfolio. What, 14%. Love it. United Healthcare Group. So if we take a look here on Qualtrim, really high cash flow yield, 6.8%. You love to see it. Again, they have more cash than debt. Amazing. Everything again ticking in the right direction, and it did have a recent drop, so I do feel it's at a pretty good valuation. Revenue, EBITDA, cash flow, everything is just ticking in the right direction. Very consistent return on capital that's above 15%. And again, the dividends it's just a stair step ladder going straight up. This is another one I really like. I don't want to add any more to it because it's already like 14% of my portfolio. But if it wasn't for that, I would absolutely be buying even more of this. It is a great stock. Next up on our holding list here is Microsoft. I love me some Microsoft. They've been growing their dividend for over 20 years. Their dividend growth rate over the last 10 years, 10.7%. Over the last 5, 9.92%. So it falls right into that 10% range that I look for. I like Microsoft more than Apple personally because Apple pays a really low dividend, and they don't grow their dividend as quickly as Microsoft. Microsoft, even though the dividend is at 1%, it's at 1%. Apple's is at like 0.6, and they grow their dividend at like 7% or something. I don't know. I just think that Microsoft's a better compounder. Now, when it comes to financial sheets, you don't get any better than Microsoft. Let me refresh here. You do not get any better than this. Everything's ticking in the right direction. Yeah, it's ran up this year, but over the last 1 year, look at this thing. This thing was in the 340s at one point. So I still feel like you're getting it at a discount, because I 100% believe that it is going to return to those levels. But again, revenue, EBITDA, free cash flow is just ridiculously taking off. I think this is a lot attributed to their cloud business, and they know what they're doing. They figured it out. This return on capital just keeps increasing. They keep buying back their shares. Love it, love it, love it. This is such a great core holding for any portfolio in my eyes. Everything in today's video is not financial advice. For entertainment purposes, just want to stress that before you go and buy things if something happens. But like, I do think that these are at good prices. Now, next up, we got American Tower Corp. Now, I do like this one a lot. This is a REIT. The really cool thing with this, they have been growing their dividend for 12 years. They increase their dividend every quarter. Every quarter. If it wasn't for V-Cheeks, I already have 10% in real estate. I would 1 billion% have American Tower Corp in my portfolio. It is so good. Its growth is so ridiculous. I think I read a thing earlier. It's like quadrupled the S&P 500 over the past 10 years, something like that. Like, it is. Let me see here. Boosh! Look at that. That is pretty good right there. Up to here. Yeah, this thing shot over 300 at one point. So yeah, you take out the recent dip, like this has absolutely been destroying the S&P 500. I think it still is, honestly. But yeah, again, revenue, EBITDA, free cash flow, net income, EPS doesn't really matter. It's a REIT, and that dividend is just it's ridiculous. I wonder if it'll show it quarter over quarter. Boop. Yeah, this is quarter over quarter. Look at that. Look at that. That's awesome. But yeah, guys, American Tower Corp, if you are looking to have a REIT in your portfolio, I can't argue against not having this. This is so good. I still want to have it in my portfolio. I just don't know where to put it. Like, I like my holdings a lot. I picked up some ADP. I got some Next Era in here now. I do like this. I like this one a lot too. If you want to know more about Next Era Energy, let me know. I can make a video on that too. But yeah, I love what my portfolio looks like right now. But yeah, just a lot of things are ticking in the right direction with this. And lastly, CVS. They released some of their I think their earnings was today, so they're up like 4%, but it's still in the 90 area. I got in below 90, but I still feel that this is at a pretty good price point. I think the average like price target, people see this going to like 120. I could easily see that, because this has been over $100 a couple of times. But yeah, pretty low payout ratio there. Dividend growth over the last 10 years, 12.21%. It's a little, I think they paused during 2020, like a lot of companies did, and a lot of companies just did away with theirs. But that didn't deter me, because before that they had a really good growth in their dividend, and it did have this recent dip, and they got good financials. I like what I'm seeing here. The revenue's good, EBITDA's pretty good, cash flow's going up, net income, EPS. There is small dips here, but I am not concerned. They just bought out, I think, Oak Street, so that's going to add even more to their balance sheet that they're going to be able to take advantage of. Return on capital is not too high, but it's not too low neither. I do feel like this is a good little compounder to have in one's portfolio. It says the payout ratio here is at 90%. I think this is something that is like a one-time thing, that they're going to get this 100% under control. I've read an article about that, because they had lower EPS for the year. 2022 threw a recession at us, and a lot of companies are still feeling the effects of that, and we may be in the middle of one right now. But at the price point in the 90s, low 90s, I still think that CVS is a great holding. I hold it here. I've got a lot of these in here: United Health, CVS, Microsoft. But yeah, guys, hope you enjoyed today's video. Again, if you have any questions, let me know. I respond to everybody. And until next time, see yous.